Forget sell in May and go away. I mean, for Bitcoin, maybe the more interesting thing to talk about is that late summer pattern, right? Why do we always seem to kind of grit our teeth through September only for things to suddenly rip higher in October?
Yeah, that contrast, that's exactly what we're diving into today. It's one of the most talked about seasonal tendencies in crypto.
The red September versus the green October.
Precisely. That really tough transition from a September that just feels weak, historically speaking, into an October that often, well, dominates.
Right, and this isn't just like random market noise. It seems pretty structural. So today, we're going to look at the data, say, 2010 through 2024.
Yep, a good long stretch.
And figure out how consistent this really is.
Yeah.
And more importantly, try and understand why. What are the mechanics, technically and maybe even psychologically, driving this shift? We're pulling from market analysis, institutional insights.
It's a fascinating look at market behavior, actually, because when you just look at the numbers, the difference between September and October is, well, it's pretty stark.
It really is. September kind of tests your patience, doesn't it?
It absolutely does. It feels like the market's just shedding risk. You used the metaphor before we started recording, like the price drops as leaves in fall. It fits perfectly.
Huh. Yeah, it does feel like that. But then October shows up.
And boom, it often rewards the people who just held on tight.
Okay, so let's dig into the numbers first. That September slump. It's infamous. And you mentioned it mirrors the September effect in traditional stocks, too.
That's right. It's not unique to Bitcoin, that underlying tendency. Investors are back from summer, maybe taking profits, maybe trimming risk. Liquidity changes. It happens in the broader market, too.
So for Bitcoin specifically, what does the data show for September?
Well, it's not pretty. Over those 15 years, 2010 to 2024, September only finished in the green 7 times.
Only 7 out of 15. Wow, that's less than half. About 47% success rate.
Exactly. Barely a coin toss, maybe even slightly worse. And the typical September, the median return is actually negative, minus 3.5%.
Oof. And that's just the median. There have been some really bad ones, right? I remember 2011.
Oh, yeah. 2011 was brutal. September dropped, what, negative 38%, I think? Just a massive drawdown.
Okay, so September is clearly tough, but that sets the stage, as you said, when October rolls around.
The whole script flips. It's like night and day sometimes.
This is the green October, the rip, as traders call it. And the consistency here is what's really striking.
It is. Over the same period, October finished higher 11 out of 15 years.
Okay, 11 out of 15, that's what, 73%? Much better odds.
Way better. And it's not just barely positive either. The gains are often substantial. The median return for October is positive 15.4%.
15.4%. That's a huge swing from September's negative 3.5%.
It's massive. And think about some specific years. 2010 was insane, like 216%. 2017, almost 47%. Even recently, 2021 saw a jump of over 27%.
So for you listening, understanding this tendency, I mean, look, it's history. It's not financial advice, we have to say that.
Absolutely critical disclaimer.
But knowing this pattern exists can help manage emotions, maybe strategy. September really tests your conviction, right? Pushes you.
Yeah.
But October often seems to reward preparation, that patience.
That leads us right into the big question. Why? Why does this happen so consistently? Especially for an asset like Bitcoin that people often think is totally separate from traditional finance cycles.
Yeah, it seems counterintuitive for a decentralized asset.
Turns out it's actually deeply connected to the gears of global finance. There are like 6 core reasons we can unpack.
Okay, lay them out for us. Start with the biggest, broadest one.
Number 1 is just that broad seasonality and rebalancing. We touched on it. September comes, summer's over, big money managers are back at their desks. It's portfolio review time.
And Bitcoin gets caught in that.
Often, yeah. Funds rebalance, Bitcoin, crypto in general. It's seen as high beta, meaning it moves way more volatilely than, say, the S&P 500.
So when funds want to reduce risk,
trimming that high beta exposure is often one of the first moves. Standard playbook stuff, really. It pushes prices down, even if it's just temporary.
So the September dip isn't necessarily about Bitcoin itself failing, but more about it being caught in this larger systemic risk-off move driven by the calendar.
Exactly. It's a function of the global financial machine, and that ties directly into point 2, positioning and expiry.
Ah, the end of the quarter, 2/3 and September 30th.
Right, and it's not just any quarter end. Late September is a major clearing point. You've got futures contracts, options contracts. especially the big ones on regulated exchanges like the CME.
The Chicago Mercantile Exchange?
Yeah, their major quarterly contracts expire on the last Friday of September. That's a huge event. Millions, maybe billions in positions are involved.
So what happens if people closing out bets, rolling them forward?
All of the above.
Okay.
Positions get closed, contracts get rolled into the next period, big institutional hedges, maybe bets against the price to protect their main holdings, those get unwound. It creates a lot of noise and often downward pressure as everyone manages those expirations.
Okay, so it's messy financial housekeeping creating volatility. But once October 1st hits,
The dust settles, the slate is kind of wiped clean. You often see institutions come in with fresh buy programs, new capital allocations for the quarter, and that can fuel that upside rip.
makes sense.
Mhm.
Okay, point 3, taxes and accounting. This one's maybe less obvious.
Yeah, it works more behind the scenes, but it's real. It's about loss harvesting.
Selling losers to offset gains for tax purposes.
Exactly. Before Q4 kicks off, some firms, some wealthy individuals, they look at assets that are down. Maybe Bitcoin had a rough patch. They sell it intentionally to book that loss.
Why?
To offset capital gains they made somewhere else, maybe on stocks or property. It lowers their overall tax bill for the year. So you get this technical selling pressure in late September that isn't really about sentiment on Bitcoin itself. It's driven by tax deadlines.
Right, selling pressure that's completely disconnected from fundamentals. Interesting. Okay, number 4, it gets even bigger picture. The macro calendar, specifically the U.S. fiscal year.
Yeah, this one's fascinating because it links this decentralized asset to, well, Washington, D.C. bureaucracy. The U.S. federal government's new fiscal year starts October 1st.
Okay, so what does that have to do with Bitcoin?
Think about what September often looks like in the U.S. politically. Budget battles, continuing resolutions, threats of government shutdowns, maybe big Federal Reserve meetings happening around then, too.
Peak uncertainty season.
Exactly. And all that political and economic uncertainty often makes big institutional players nervous. They tend to de-risk, pull back from more speculative assets, and Bitcoin definitely falls into that category for many while they wait to see how the DC drama plays out.
So you're saying a deadline Congress set back in the 70s is indirectly adding to Bitcoin's September volatility. That sounds kind of wild. Correlation, not causation.
It's definitely indirect, not a direct cause and effect, maybe, but the effect is there. Heightened uncertainty leads to de-risking in September. Then, if October 1st arrives and, say, the government doesn't shut down or a budget deal gets done.
There's a sigh of relief.
Yeah, a relief rally or just renewed confidence. The anxiety lifts, allowing capital to flow back into riskier assets, helping that October rally. It's the removal of uncertainty.
That's a really powerful structural point. Wow. Okay, number 5, catalyst clustering. What's that?
This is about strategic timing by institutions and companies in the crypto space. They're not dumb, right? They know Q4, especially October, tends to be stronger. There's generally more optimism, more capital flowing.
So they save their big news for them.
Pretty much. Why would you launch a major new product or announce a huge partnership during a historically slow or fearful month like September? You wouldn't. You time it for maximum impact when people are feeling more bullish and ready to buy.
So they deliberately try to ride the positive wave of October.
Exactly. And this creates a positive feedback loop. Think back. PayPal rolling out crypto services. That was October 2020. The first U.S. Bitcoin futures ETF launching, October 2021. Big players use the historical tendency to amplify their news.
Clever. Okay, and the last point, number 6.
Yeah.
This one's almost philosophical. Memes and expectations.
Yeah, this is where it gets a bit meta. The whole red September, green October thing. It's become known. Traders know the history. They talk about it.
So the expectation itself starts driving behavior.
Precisely. If enough traders expect September to be weak, they might sell proactively in late August or early September, or hold off on buying. Then, they anticipate the October bounce, so they get ready to buy aggressively as soon as the calendar flips.
Creating a self-fulfilling prophecy.
Kinda, yeah. It's an example of the market trying to be efficient, anticipating known patterns. Everyone tries to front-run the move.
Okay, that's a comprehensive breakdown of the why. So you've got seasonality, expiries, taxes, the fiscal year, strategic news timing, and market expectations all sort of converging.
Right, it's a confluence of factors.
Now let's talk about the current market for a second. Michael Saylor has an interesting take on the selling we sometimes see during consolidation periods, like when Bitcoin is maybe chopping around in the teens or wherever it might be finding support.
Yeah. Saylor offers a really useful perspective here. He argues that a lot of the selling pressure isn't panic selling, it's actually, well, healthy, necessary even. He uses this great analogy.
Remind us of that analogy. It really shifts how you might think about price dips.
He compares the early Bitcoin holders, the OGs, to employees at a super hot tech startup like one of the Mag 7 who got incredibly wealthy from stock options they received when the stock was worth pennies.
Okay, so they're rich on paper.
Massively rich on paper. But here's the catch. Unlike holding, say, Apple stock, it's still harder to borrow against Bitcoin easily. The infrastructure isn't quite there yet for huge loans against crypto for most people.
So they end up Bitcoin rich, but fiat poor. They need actual cash.
Exactly. Life happens, right? Their kids need to go to college, maybe they want to buy a house, or just diversify a small percentage because, having 99% of your wealth in one volatile asset isn't ideal for everyone.
So they have to sell some, not because they've lost faith, but just for life expenses.
Precisely. Saylor suggests maybe they sell 5% or so to fund these real-world needs. And the market, especially during consolidation, is absorbing that steady stream of selling from the early guys cashing out a bit. So his point is, when you see the price dip, don't automatically assume it's bearish sentiment. It might just be funding someone's tuition or a down payment.
That totally reframes it. It's not necessarily a vote of no confidence. It's more like a natural part of the asset maturing, distributing ownership.
Which leads right into this idea of the maturity conundrum.
Yeah, this is key for the next phase. For the really big players, the BlackRocks, the Fidelities, the pension funds, to come into Bitcoin in a truly massive way, they need one thing above all else.
Yeah.
Lower volatility.
They can't handle those wild 40% swings we talked about.
Not with retirement money, no. So for Bitcoin to attract that next wave of massive institutional capital, it almost has to become, well, a bit more boring. The daily price swings need to calm down.
But that boredom might be tough for the early adopters who love the adrenaline rush, right? Absolutely. That's the conundrum. The very volatility that attracted early speculators needs to decrease to attract the long-term, stable institutional money. Some early holders might get impatient or even sell because the crazy gains aren't happening every week anymore.
But it's a necessary phase.
It seems like it. It's a growing pain. You need some of that early supply to come onto the market, maybe from those OGs paying for life stuff, to make room for the huge, slower-moving institutional buyers. It's a trade-off for wider adoption.
Okay, but this brings us to a crucial point of caution. We've laid out this strong historical pattern for October, but we absolutely need the contrarian view here. It's a tendency, not a cast-iron guarantee, right?
100%. History informs, it doesn't dictate. You cannot just blindly assume October will be green because the calendar page turned. That's how you get wrecked.
We have to look at the exceptions. You mentioned 2011 earlier.
Yeah, perfect example. September 2011 was abysmal, down 38%. But did October magically fix it? No. October 2011 was also a red month. The broader market conditions, whatever was happening then, simply overwhelmed any seasonal tendency.
So the bottom line is, history is useful context, but it's not a crystal ball.
Not at all. You still have to manage your risk. You still have to pay attention to the actual news, global events, regulatory changes. Anything could override historical pattern. Black swan events happen.
Use history to manage expectations, maybe temper emotions, but not to make concrete predictions.
Exactly. Prepare, don't predict.
Okay, great summary point. So let's wrap this up. Key takeaways for everyone listening. First, that core difference. September historically tests conviction. It's driven by those macro factors: institutional housekeeping, uncertainty. October, historically, tends to reward that patience, often significantly.
Second, the why isn't mystical. It's structural. It's tied to real-world financial plumbing. Portfolio rebalancing, derivatives expiries, the U.S. fiscal calendar, tax behavior, and strategic timing by industry players, plus market psychology building on itself.
All right, and here's that final provocative thought to leave you with. We talked about institutions clustering catalysts in October. Given that tendency, and knowing the structural setup is often in place by then, what big news could be waiting in the wings this year? Could there be major policy updates tied to the U.S. fiscal cycle? New product launches from major players timed for Q4? Regulatory clarity? The historical pattern suggests October is a prime time for big moves.
It definitely means we should be watching closely as Q4 begins.
Yeah.
The stage is often set. We just need to see what actors decide to step onto it this year.
Excellent point. Keeps things interesting. Okay, that's our deep dive for today. If you found this useful, please do follow, like, and share this session. We'd really appreciate it.
Yeah, helps get the word out.
And for more content like this, you can follow What Bitcoin Taught Me. We're on Twitter X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn. Pretty much everywhere.
And just one final reminder, Everything we talked about today is based on historical analysis and our source material. It is absolutely not financial advice. Please do your own research.
Couldn't have said it better myself. Thanks for tuning in, everyone. Until next time.